Well, my name is Avery Michaelson, and I've been at SocGen for over 3 years now. I am a member of the Insurance and Pension Solutions team, and I focus, as David introduced, on the distribution of longevity risk. I'm also joined at the conference by two colleagues, Onno Vlieshouwer, who heads our longevity business from London, and also by Gali El-Boukfawi, who leads our engineering effort. So the topic of my speech is around index and indemnity transactions, and obviously Andre did a very nice job of introducing this topic, so I'll be able to move a little bit quickly through some of the elements that were already covered somewhat extensively and just focus on some of the differences that I would like to point out. So, as I was looking for a quote or something to orient us around this topic, I stumbled into something actually discovered by a French chemist, Antoine Lavoisier, in 1789, conservation of mass, that mass can neither be created nor destroyed. It can only be transformed into other states or rearranged in space. And while it can't be as rigidly applied to the concept of longevity, I thought it was still somewhat relevant, and perhaps a theory of conservation of longevity could be that longevity risk is neither created nor destroyed. It's only transferred to others or transformed, and in fact that's the purpose of the index and indemnity solutions. They are the things that transfer and transform longevity risk and move it around. However, neither of those things actually destroy longevity risk. That's not so much possible. So, the title of the speech, as given, was Indemnity versus Index Transactions, and are they really as much in competition as that title would suggest? I think I'd put forth, and this kind of echoes on Andre's speech, that they aren't as much in competition. They both very much do have their place within the longevity risk transfer value chain, and based on the particulars of each of those transactions, they become more or less relevant in certain situations. So, this is the slide that I can move somewhat quickly on because I think we've already gotten pretty good definitions of what indemnity hedges are and as well what index-based solutions are. But very briefly, we see the indemnity-based solutions are a fixed set of cash flows against a pre-arranged longevity assumption and providing full longevity risk transfer against the specific lives within the pension or annuity portfolio. And in contrast, the index solutions are a fixed and often level premium against specific cohorts of general population mortality. So that's mortality data reported by national statistical agencies. It's readily available data. And what we see is that indexed hedges do mitigate the exposure to observed mortality changes over the, for example, 10-year risk period, as Andre introduced, and similarly having a commutation to deal with changes in the future expectations of longevity, but again, within the context of a fixed and agreed-upon model. And again, the index solutions do leave basis risk with the hedger. So, there is a fairly clear value chain for longevity risk that has emerged over the last decade or so, in which we're seeing more and more pension funds and corporate pension funds primarily realizing that the pension is an unrewarded source of risk and very much a distraction from the core operations of the business. And so they're starting to transfer that risk in increasing fashion to the insurance companies and reinsurance companies. And the transaction that is most appropriate for them is to use an indemnity transaction. Their objective very much is to cover the specific lives and guarantee the payments to their pensioners. Often that's on the way towards fully terminating the pension itself and removing the obligation in its entirety. And so they're using transactions like the pension buyout, the pension buy-in, the actual to expected longevity swap for them to remove that risk in indemnity format. And now the and pension risk transfer we know is, or we expect, is poised for a great increase in transactions. Part of that is as a result of the generally increasing funded status of pensions globally, with equity markets having maybe concluded a very long bull run, and to the extent that interest rates were to tick up, in the United States or elsewhere, that would certainly bring many more pensions towards closer to funded status, although I realize that's a big if still at this point. But now, once the pension de-risking has occurred and the longevity risk is moved to the insurance company or the reinsurance company, there are pretty significant capital charges, and those capital charges are coming under Solvency II, which is soon to be implemented in Europe and the UK. As well, rating agencies are increasingly taking note of longevity risk transactions and incorporating them into their capital models. And obviously, insurance companies have their own view of the risk and may assess a capital charge against that as well. And under the capital charges can be quite significant when we think specifically about the case of Solvency II with a standard formula shock of a 20% decrease to mortality rates that could create a longevity risk SCR estimate of around 6 to 8% of the best estimate of the liabilities. And if that SCR needs to be financed at, for example, a 5% cost of capital, that's adding a 30 to 40 basis point charge against managing that liability. When we think about corporate single A corporate bonds yielding only 3 to 4%, that's absorbing upwards of 10% of the yield that the insurance or reinsurance company may be obtaining from managing those assets against the liability. So we know that those capital charges can be quite significant, and that obviously leads the insurance and reinsurance companies towards desiring some longevity risk hedging. And here's again where the choice of indexed and indemnity solutions come in, and the purpose of the transaction to be to actually reduce the capital charges. But in addition, that's also obviously mitigating some of the exposure to extreme longevity outcomes, and also reduces the volatility of the capital position and the volatility of reported profits by hedging as well. So then at the end of the value chain, obviously that longevity risk has to be absorbed by someone, and this is the area that I focus on primarily, is on syndicating that longevity risk. And longevity risk is increasingly grabbing the attention of capital markets investors. Obviously, there's a desire to find uncorrelated investments. There's a desire to find yield in the markets, and potentially longevity risk is able to do both of those things at the same time. But against that, investors have to be able to deal with limited liquidity in these transactions at this point, and there's certainly an element of sophistication in longevity risk modeling, and it's for those reasons actually that the investors are primarily the ones listed on this slide, the large global life reinsurers, life insurers who have expertise in longevity and mortality risk, but also we're seeing now demand and interest from sophisticated institutional investors, foundations, endowments, insurance-linked securities managers, and to the extent we're able to bring transactions, we know that universe will continue to grow. So, to drill down on the longevity risk hedging, as the insurers and reinsurers that have those capital charges think about the hedging opportunities that they have, they certainly have both the indemnity transaction and the index transaction available to them. And as we would say, as we believe, the objective is really to create a high return on capital for that longevity business, and therefore they should select the transaction which provides them the lowest cost of capital for the capital relief that they're achieving. Okay? So, how do you actually generate a lower cost of capital? How can that actually be achieved? Well, in order to generate a low cost of capital, we think it's essential to achieve two objectives. First off, you need to extract the lowest price from the market by creating a competitive syndication process that includes the capital markets, right? So creating competition is the element that can drive prices down. We do now know that there are reinsurers and insurers and capital markets providers of this capacity, and we think the process of putting them into competition is the thing that's going to lead towards the lowest cost of capital. But in addition, you need to make the structure and the analytics work in the favor of the hedger, and that's a topic that one of my colleague Gali at the end will share a few comments on as well. So, as the title says, investors have a preference for index solutions, and there are some specific dynamics of indexed and indemnity transactions that are going to make them dramatically more appropriate for the broader base of investors, right? And so when we think about indemnity transactions first, there could be a perceived or real information asymmetry between the amount of data that the investor can obtain on the specific lives in the pension, and so there would always be some perception that what do I not know as an investor? What piece of information am I not obtaining? And somewhat of a corollary to that is it's a much more complex underwriting process that would have to be taken to think about the idiosyncratic risk of 10,000 pension lives or even 100,000 pension lives. How do these lives perform relative to the general population on which I might have more data? And maybe even more important than either of those first 2 points is the long duration of the indemnity transaction, given that those transactions have to take the liability all the way out to term, which for a 50 or 60 or 70-year-old may be an additional 40 to 50 years. That clearly is not going to be an investment duration that many capital markets or even any capital markets investors are going to find appealing. And somewhat, tack on to that point is that because of that very long duration and there's no fixed bounded loss potential. So the loss potential for the investor could be, in theory, infinite, and that's going to be something that's not going to be appealing as well. To put that in contrast, some of the reasons why the index solutions do have appeal in the capital markets is somewhat the exact opposite of that. These transactions are based on general population mortality data, so we're able to download, everyone is able to look at all of the same data, both historically and prospectively, and that leads to a much easier analysis process using some of the generally available longevity models, some of which are created by people in this room. And as well, there is a fixed, generally on these index transactions, a fixed notional that the investor will sign up for, so they know what is their maximum loss potential as well. Now, these last two, the second to last point there, liquidity may develop in time. This is something where we know we're not there yet, but with the index solution, we think there's a much greater opportunity for liquidity to develop. Mostly because of some of these same points, and as more of these index transactions are done and more investors enter into it, we do expect liquidity to develop. Now, another aspect that we have not yet seen, similar to liquidity, is the potential for a longevity note to be issued, and that would be somewhat of a breakthrough transaction, we think, for the longevity risk space, in that it would reduce the credit constraint for the hedger. They would have a fully collateralized position from the investor, and that would enable unrated counterparties to consider these transactions as well, given that the hedger would be able to obtain the credit that they need from that reinsurance transaction. So all of that leads us to believe quite clearly that index-based solutions are going to be the method that will generate the most competitive syndication process, and that is the element that we think is crucial to driving that cost of capital lower. So if we were to answer our question in a sense, index-based transactions we think are more appropriate for the hedging of longevity risk and obtaining capital relief at an attractive cost of capital. So now I'll pass it off to my colleague Gali to talk about the analytics of it.
Thanks, Avery. Hello, everyone. I'll try to make it relatively short. So, as Avery mentioned, two elements that we think are important when looking at longevity hedging, the competitive effects and the how to make the analytics work for the hedger, and all of that in the context of optimizing cost of capital. So that's a cost-benefit analysis that goes through these analytics. So, again, simplicity can leave money on the table, or said differently, sophisticated analysis can sometimes create value. So I just want to touch on three examples of sophisticated tools that actually help in terms of optimizing cost of capital when looking at hedging longevity. Nested stochastic, and I know there was a talk yesterday around that. When you look at a Solvency II, capital relief transaction over time, you need to look into a distributional view of that capital relief. At time zero capital relief may not give you the full picture. And, as mentioned before, the index transaction, the index hedge, being a call spread on a synthetic annuity, it has asymmetry. So you need to have this distribution view in order to capture, things that could happen in a year or two. So your hedge may be efficient at time zero, but longevity can develop in different direction, year 1, 2, and 3. Therefore, you need to be able to produce those distributions. Always useful to have a close pricing formula for your longevity option. And in our case, since we're looking at nested stochastic, it becomes even more important. In particular, when looking at a matrix of different strikes and maturities for your index solution, you need to crunch through numbers many times with different combinations of, say, notionals or commutation types. So having tools to quickly compute future capital reliefs and expected payouts are also useful in that sense. And finally, the last example I wanted to mention is having a range of tools, a range of stochastic mortality models, and that's important because not all models are created equally. Some models have improved goodness of fit, but don't capture things like cohort effects. Being able to reproduce, for example, or at least get close to the hedger's view on the risk, which is very important in terms of calculating the value of a transaction. You have to know, or at least approximate the hedger's view of the risk. And in the context of Solvency II, you can find large ranges of models that could be either derived from traditional models we see in the academy or simple standard formulas. So in this optimization process, in order to get to that optimal cost of capital, these tools are fairly important and actually, in our experience, turn out to be key in certain types of optimization and transactions. That's all I had, Avery. Thank you.
Great. So that concludes our prepared speech. As you can see here and may have guessed, SocGen is a leader in index-based solutions. We do look forward to speaking with anyone further outside of this session about the transactions if you'd have interest.
Yes, thank you very much. It was really interesting. So we talked quite a lot about the claims leg. I will talk a lot, ask a question about the premium leg, because if we are an investor, it's something that is interesting for us. And so what do you have to propose for this thing to evaluate the premium leg? Which kind of thing that we saw with RGA, this fixed premium leg, but do you think about something like in cat bond linked to an interest rate model, 3 monthly LIBOR plus a spread? What do you think? And maybe you can answer.
Not so sure that I understood the question there, but from a structural standpoint, the index solution that we are proposing is very similar to the one that Andre had introduced, in that there is a fixed premium that the investor receives on either a quarterly or monthly basis, again with a terminal payment, a contingent payment that is going to be based on the final indexed value. So we're creating a customized index with the client. That index is customized to reduce the basis risk for them, and at the end of the transaction, we do witness what is that final index value relative to our the strikes that were defined. These are the 5 and 10% shocks that Andre had introduced, and so it does function somewhat similar to a cat bond in that the investor is receiving a premium and does have a final contingent payment based on some event. That event was longevity long enough such that the index did come into the money or breach the strikes. Did that?
But yeah, that's okay. So it's always in your mind it's fixed, but not linked to a spread plus an interest rate. Or
That's right.
something.
There isn't additional upside to the investor beyond the fixed premium that they've contracted at the beginning of the transaction. So, again, I'm not sure if that's on it, but
I have an idea about what you do,
Okay.
but maybe I think maybe it's an obstacle for everybody in the market, because if we compare what we have on insurance-linked securities with the spread and on the market, LIBOR plus the spread, and here it's only a premium leg with only a fixed amount, and so you're discounting this premium leg, and you have this claim leg that you evaluate, and you try, I think, to have the same amount to have the market price, and yeah, so I think you
okay.
you answered to my question. Thank you.
But the fixed leg can be swapped into a floating leg, right? I mean, that's...
You could certainly use interest rate swaps, and Sakchen is happy to talk to you about interest rate swaps as well.
Right. Great question here.
Good question.
Thank you. Can you hear me? From a Solvency II perspective, how much capital relief will typically get in terms of treatment from Solvency II? How much capital relief would you get from an index swap as
Sure.
opposed to an indemnity swap, which is actually customized on the block
Well,
of
an
life?
indemnity swap would fully remove that risk to the extent you were right. And so the index swap is the capital relief that you achieve is going to be dependent on the maturity that you set, dependent on the strikes that you've set. If you can envision the final charts that Andre was using that showed the capital relief over time, dependent on how far out of the money or close to the money, that dictates how that capital relief holds up over time. So there isn't really just one answer. It'll be totally dependent on the strikes that you set.
But would you get close to 100% of a capital relief when you account for the longevity risk? I mean, typically, what is the range of ratios that you would achieve with the
Sure.
solution?
Well, there is the element of basis risk that is going to reduce the capital relief. We're not actually making a statement, publicly about what that basis risk haircut would be. There is a haircut. The elements that we use to reduce that basis risk and actually get it to be quite quantifiable are the elements of selecting the cohorts, providing a relative weighting of those cohorts, and further, we have an experience ratio matrix that allows the hedger to reflect their relative view of their book of business to the general population. So we think applying those three things in customizing the index is able to get that basis risk to be somewhat small and quantifiable, although not kind of publicly stating exactly what that is, because that will certainly depend on, again, the setup of the hedge that you've chosen, the particulars of the hedger's book of business, how large that is, and how much historical data they have to parameterize that basis risk analysis.
I guess if I may, that's working. Yeah, just a comment. You may not get the full capital relief under one type of transaction versus the other, but ultimately, as Avery pointed out, the main element is looking at the cost of capital. So you may see an indemnity hedge that actually is priced at a certain level, taking into account whatever available data from the sponsor, which may not be a lot. Sometimes you have maybe up to 10 years of indemnity data, whereas when you look at general population indices, data is available and you get access to a larger set of investors. Therefore, you get that competition effect, that syndication effect that brings the premiums down. So ultimately, you end up at a cost of capital, even with taking into account basis risk. You can haircut your capital relief, and that's what you need to look at to compare between different structures.
Any other questions?
Yeah.
Oh, right.
Avery, or perhaps Andre as well, could you give some insight into why typically, say, a 10-year maturity is the right number rather than, say, 20 or 5?
Sure. Well, from my perspective, I would start that with the interest from investors, back to the concept of having the most competitive syndication process possible. As you go towards a maturity that's much longer than 10 years, and I won't define it as hard cutoff at 10 years, but as you start drifting longer and longer, you will start losing some of the capital markets investors. As you go shorter, obviously you're getting less transfer, less capital relief. And so, there is a certain amount of work that goes into these transactions and costs. And so, there may be a sweet spot around that 10 to 12-year maturity that marries those two issues of how much capital relief do I get and how much interest do I get from the various market participants.